In the previous 10 to 15 years, the financial markets experienced extraordinary expansion. In particular, the stock market had one of its finest decades 10 years after the global financial crisis peaked, and in the nearly 140 years that have passed since then, the S&P 500's earnings have roughly doubled and its price has more than tripled. Cheap money was clearly a major catalyst for this remarkable expansion, given the highest interest rate at the time was 2.5% in 2019. So getting money has become simpler and less expensive. Consequently, this has made it simpler for firms to grow, for investors to profit more, and for valuations to increase. By the end of 2019, people believed that anything they acquire quickly doubles in value. The bubble eventually burst, but this time it was due to a pandemic. Eventually, the legendary 10-year run came to an end. As investors' enthusiasm began to wane, they began to withdraw their money from the stock market. The pandemic caused global chaos. The financial markets collapsed and businesses were closed. The investing industry was pushed to its knees by the recession, which was bleak. In order to assist their governments in paying for some of their pandemic-related expenses, central banks around the world began creating money. The US Fed printed trillions of dollars in a similar manner. Ultimately, stimulus checks, bailout packages, and other forms of free money were poured into the economy, but they were unable to help American citizens. The economy was inflated by the debt monetization, which caused the US to experience a 40-year high inflation rate in June of this year. And right now, Americans are suffering from decades-high inflation, making everything unaffordable. The US Federal Reserve once more intervened and began hiking interest rates, but the results are terrible. Due to this increase, it is now more challenging for people and enterprises to acquire credit. With the panic spreading to the financial markets, these extreme actions have put a stop to the economy. Furthermore, we observed a wild decline in cryptocurrency prices. Many well-known companies in the business are having trouble. Both the equity market and the real estate sector are in decline. Investors have sold off, substantially as a result of worries that a severe recession is about to hit the world. But for investors, when is the best moment to invest? When everything is on sale, or when the markets have already reached their peak? Recession times are the best times to make money, according to the investing community. Nobody can predict with certainty when people will experience another period in their lives when everything will be on sale because crashes often happen over a long period of time. Is now the ideal time to increase your money though? Let's get to the bottom of the question whether this is the correct time to act, and if so, how one might do so. Some people shouldn't even possess stocks since they are overly sensitive to price changes. You shouldn't own stocks at all if you're going to act foolishly when your stocks drop. The psychology of investing is complex. Investing's basic tenet is to buy low and sell high. People, however, act in the exact opposite way. When prices are high, they buy and then sell. In spite of their best intentions, people tend to leave the markets during difficult times because uncertainty and fear paralyze them. But according to the renowned Warren Buffett, Charlie Munger, Monish Pabrai, Guy Spier, Phil Town, and many others, investing is best done when the market is severely down. This phenomenon is intriguing. The majority of people don't seem to have specific investment goals, which is the main cause of this retrograde psychology. In most cases, they are not dedicated to a long-term investing time horizon. As a result, when times are tough and a recession occurs, instead of seizing the chance, people flee the immediate upheaval. It's a bad tactic. Warren Buffett explains that we're a net buyer of stocks over time, so who wouldn't prefer to buy a cheaper price at a higher price? He thinks people are strange about this, since most investors are savers, so they would want the stock market to go down, so they can buy at a lower price. Let's examine the historical bull and bear markets in the US since 1926. Bull markets are blue, whereas bear markets are orange. You might see that recessions are outbarred. The US has experienced 11 bear markets and 15 recessions since 1926, as can be observed. If we include the pandemic crash in 2020, there will be 12 bear markets. In total, bull markets lasted for 75.4 years, while bear markets persisted for 14.7 years. However, it is a truth that if you had made investments during these tense times, you would have gotten good returns. For instance, profits following the Great Depression were around 265% over a period of 4.4 years. Then in 1.8 years, people made 43%. In 4.1 years, 210%, and in 14.8 years, over 900%. People who made investments during the biggest bear markets in recent history had gains of 20 to 50% in just a year. Although there is no ideal market in which to invest, these trends demonstrate that these bear markets do present excellent possibilities. For instance, you would have profited 9% on your investments if you had invested at the peak, right before the 2020 COVID outbreak. On the other hand, you would have profited 60% if you had invested at the market lows, which were a few weeks following the peak. This is how a difference-making entry point works. But keep in mind that such large drops don't happen often. Therefore, it may be said that recessions present excellent investment possibilities. But how do you make use of this chance without messing up? Step 1 is to keep updated with market events, so you can anticipate when these possibilities may present themselves. Step 2 is to effectively implement your strategy, whether actively or passively, as soon as you detect a market crash. We are all aware that there are a few approaches to long-term investing. Either dollar cost averaging is used, or long-term value investment in the manner of Warren Buffett. Nowadays, the majority of consumers choose dollar cost averaging. For those who are unfamiliar, dollar cost averaging is the process of taking money and distributing it among different stocks. It is accomplished by, for example, investing in index funds like the S&P 500 index fund, the biggest index fund in the world. They consequently opt for the market tracking investment. Investors regularly invest the same sum into the market tracking investment fund. This strategy is intended to reward the market over the long term, which is typically 10% yearly for the S&P 500. With this method, you don't appear to be timing the market or taking advantage of a market downturn, but you actually are. For instance, on October 9, 2007, you bought $2,000 shares of SPY, which are currently trading at 12.78%. You received 20.5% shares a year later, as the market was able to tumble by $2,000. This is easy. When stocks are cheaper, you buy more of them, and when they're more expensive, you buy less. For passive investors, this is the greatest method to take advantage of the situation. Aside from this, investors embrace Warren Buffett's strategy of buying individual firms because they want more control over their portfolios. They are aware of their competitive advantage, as well as their astute management teams and bigger price margins for safety. We won't discuss this tactic in this discussion. However, we'll see how proactive investors make sure they don't commit any errors when investing in a volatile market. The first thing we need to figure out is what's driving all of this to hurt businesses. At the moment, it's rising interest rates and inflation. This implies higher prices, lower consumer spending, and more expensive loans. So the question is, how can we determine whether a business will survive such circumstances? The company you're considering must have pricing power. This indicates that they have attained a position of competition. Quite simply, they have the ability to raise prices without experiencing a decline in sales. For instance, many companies are lowering their costs as a result of people spending less on luxuries. However, companies like Coke are resilient enough to raise prices without experiencing a decline in sales during the inflationary period. With the increase in Coke's pricing, companies can pass the expense on to customers without hurting themselves. The other element is an increase in interest rates. One effect of this is that debt costs rise, therefore you must make sure you have little debt if you want your business to function successfully during these times. For instance, if we look at Google, they have more cash than debt. They make more interest than pay due to their 0.5% debt-to-equity ratio. Meta is even more adept at not having any debt. According to Peter Lynch, closing your firm becomes more difficult if you owe little to no one. The business model is last but not least. You must check the business models you're using. Will it be able to survive tumultuous business conditions? For instance, supermarkets. Such models perform during better recessions. This is a result of people's insatiable appetite for essentials. Active investors should consequently consider the business concepts, pricing power, and debt levels. However, for passive investors, it's all about hanging on for the long haul and remaining steadfast. Well, that's about it for today's video. If you found this video helpful, kindly click the like and subscribe button. Also, you might want to leave a comment below. We love hearing from you. Thank you for watching, and we'll see you in the next video.
If you enjoyed this video, you're going to want to watch one of these two videos right here. Enjoy!